keep on. Today in this video, we're going to understand on what are the components that are necessary to understand the financial statements of banks or any other organization. So this video will give you an understanding on how do you analyze a particular balance sheet of a particular company, which talks about the assets and liability position. How do you analyze the P&L reports of the particular company, which talks about the profitability position? How do you analyze the changes, the statement of changes in equity, which helps us to understand the equity position of the shareholders in the organization, the amount of dividend that is being paid by the company to these shareholders, and the reserves and surplus that these companies have. With that, we will also be understanding on what are cash flow statements and fund flow statements, from where do companies receive cash, how do they meet their expenditures, what are their inflows, outflows, etc. So in this video, on a whole, we are going to talk about the components of a financial statement that is necessary for analysis of financial statements. Moving ahead, the first and foremost thing that we must remember before understanding financial statement is that whether the financial statement is prepared in accordance with the IFRS standards. Earlier, we had the GAAP principles that were followed in order to prepare financial statements. But since the companies are rapidly growing and the network of the companies are growing globally, there was a need for the companies to maintain a standard operating procedure in order to follow the accounting systems and procedures. And therefore, the concept of GAAP is being replaced with IFRS standards now. So financial statements generally are formal records that help you to summarize the financial performance, financial position, and the cash flow of an equity. Now, according to IFRS statements, IAS 1 says that the presentation of financial statements the major components which include are balance sheet, P&L, cash flow, fund flow, and the statement of changes in equity. So in this video, we will try and analyze what is the purpose of preparing each of these financial statements and what are the key elements that you must focus on while analyzing these financial statements, which help you to analyze the profitability, liquidity, and solvency position of the company. So here we are trying to understand the statement of balance sheet. So if you look into the balance sheet preparation as per Companies Act 2013, it is a structured presentation which talks about the entities or companies' assets position, liability position, and equity at a specific point of time. Now, why do you prepare balance sheet? Is it simple to understand what the company owns in terms of assets and what the company owes in terms of liabilities. The major purpose of preparing a balance sheet is to help and determine the financial stability and the liquidity of an organization. The balance sheet also provides us information on the capital structure of the company, on how well the structure of the capital is being formed, how much of equity the company has, how much of preference the company has, how much of debenture the company has, including the shareholders' funds and long-term obligations. Now, when you analyze a particular balance sheet under financial analysis and reporting, the key elements that you must take care while analyzing the balance sheet are the assets. When you look into the asset side, majorly we divide the assets into current assets and non-current assets, which includes our long-term capital as well, the long-term assets as well. So under current assets, the two major elements that we must concentrate while preparing financial analysis of reporting are the cash and the inventory. And when it comes to non-current assets, we majorly look into what types of properties the company has, what equipment the company owes, and what is the worth of these assets and asset positions that the company has. Moving on to the liability side, the major liabilities are classified into current liabilities and non-current liabilities. So if you look into current liabilities, the elements that we concentrate for financial analysis is creditors. That is how much the company owes to be paid to the outsiders. That is concentrated, and the amount of short-term loans that the company has borrowed from different financial instruments, financial companies, or any other loans and advances that the company has, and which the company should repay within a shorter period of time. When we move on to non-current liabilities, we majorly concentrate on debentures and long-term loans. Now, why debentures is because irrespective of the profit of the company should pay interest to the debenture holder. Therefore, debenture becomes a key element while analyzing the balance sheet of the company. Now, apart from the liabilities, which is classified as current liability and non-current liability, we also concentrate on analyzing the equity position or the share capital position of the company, which talks about how much of equity shares the company has, how much of preference shares the company has, what are the company's reserves and surplus, and how much is the retained earnings of the company. So these key elements form the basic understanding on analyzing the balance sheet of a particular company, becoming the first very important document for financial analysis. Now, moving on to the second statement of financial analysis, where we are going to talk about the statement of P&L, which is otherwise called as the income statement. Now, why is the income statement prepared? First and foremost, the statement helps you in analyzing the profit and loss of a particular company, which reveals the revenue that is incurred by a particular company over a period of time, the cost or the expenditures that is incurred by a company over a period of time, and the net result leading to net profit or net loss, which is very important to be analyzed in order to make any strategic decisions. This statement aggregates all revenue streams and expenses categories to show the total performance for a specific reporting period. For example, usually we prepare P&L account for a period of 1 year. So during a period of 1 year, this P&L account gives me an analysis of the revenue streams that are incurred by an organization and also the expenditure categories that gives me an overall analysis of the total performance. Now, how do you analyze or interpret a P&L account? What are the key elements? The key elements in the revenue statements that we try to analyze are firstly revenue, which talks about the total income from the primary business activity that is being conducted by a particular organization or a particular bank, which includes sales and service incomes. The second element that we analyze in case of P&L account is your cost of goods sold. That is the direct cost that is attributable to the production of goods sold by the particular company. Third thing that we analyze is the operating expenses, which is an ongoing cost, which will increase or decrease depending upon the running capacity of the business or the operational capacity of a particular company or a bank, such as salaries, rent, utilities, etc., which are tend to vary or fluctuate over a period of time. The next category or the next element that we analyze is the tax expenditure, the amount of tax that is paid by the organization towards the government organization. So the amount charged for income tax based on taxable profit for the period is what we'll be analyzing there. And finally, from the P&L statement, we analyze the net profit or loss, which is the final result after deducting all expenditures, costs, and the tax from the total revenue. Now, overall, on a whole, why do we analyze the P&L? Firstly, to measure the profitability position of the company, which compares the total revenue against incurred expenses and costs. Second reason for doing analysis of P&L is to show the operating efficiency by highlighting expense ratios and margin relatives to revenues. And the third reason is to assist investors and management in performance analysis and comparison with the past period and to inform them that these are the strategic decisions that we have to take and we have to lead in the future. So this is the reason why the second statement of financial reports are being done, which is called the P&L or the income statement. Now, moving on to the third financial statement that is very necessary for analysis is the statement of changes in equity, which talks about the current ownership position of the company. In that sense, we talk about how much of capital the company has in terms of equity, what is the ownership position that is being held in terms of equity by the company, how much of dividends the company paid to these equity shareholders out of the profit that is incurred over a period of time, how much retained earnings are kept with the company, and what is the reserve balance of the company. Now, why is this statement of changes in equity required to be analyzed? First and foremost, it is important to be analyzed because it helps you to assess how profits are used, whether it is distributed fully or whether it is retained for growth and expansion of the company or for diversification, etc. If it is retained, what proportion of the profit is being retained and what proportion of profit is being divided among equity shareholders and dividends. This is the main reason why we analyze the changes in equity. Now, the key elements that you must focus on analyzing the statement of changes in equity are the opening equity balance. That is, at the beginning of the year, how much of equity balance does the company have, and what were the changes, whether there was any increase or decrease in the equity balance after the beginning of the financial year that has been analyzed, and the profit or loss over a period of time. Now, this opening balance of equity and profit and loss is related to the amount of dividend that the company has paid over a period of time to the equity shareholders. And also, it helps us in analyzing the issue or buyback of shares. And also, it helps us in doing a comprehensive income statement adjustment, which helps us to analyze how in future the equity of the company could be borrowed or adjusted in the near future. The fourth important statement of financial analysis is the statement of cash flow. In simple, cash flow statement helps us in analyzing the cash inflows and outflows for a particular organization, which are split into operating, investing, and financing to reveal the liquidity and earnings quality of a particular organization. Now, why do we prepare a cash flow statement? In simple, it helps us to understand or indicate the cash generation ability and the liquidity position of a particular organization. It also helps the stakeholders to assess the quality of earnings in which the company has been performing, and it also aids in forecasting future cash flows. The other sections of cash flows where we concentrate on is to do the operating activities, investing activities, and financing activities of the business, where we try to analyze what is the cash that is generated by the company from the core operations. We try to analyze the purchase or sales of assets from a particular activity. It also helps us in understanding the financing activity of the company in terms of borrowing, dividends to be paid, equity issues, etc. So cash flow statements in simple gives us an overall view of how cash is being generated and cash is being utilized by a particular organization. Coming to the end of the financial statements, when we prepare a P&L account or when we prepare balance sheets or any other mandatory financial statement as per IFRS, we tend to write note to accounts, which matters a lot in order to provide clear and trustworthy financial reports. Now, why notes are always written at the end of the financial report is to give an explanation on how various uncertainties of the companies have been tackled and to increase the transparency for users of financial statements. It also helps us in providing an explanatory statement for forming an integral part of the financial statement, and also provides additional details about accounting policies, the estimations made, and majorly the assumptions that are noted down while preparing these financial statements. These notes to accounts also matters a lot because it provides a clarity in the items that require financial explanations. For example, if there are any contingencies that are recorded. What are these contingencies? Why is it recorded? All these assumptions or additional notes and explanations are being given, which tries to enhance the transparency, making financial reports more understandable. Now, these become the major component for major financial statements that become a component in order to analyze the financial position of the company. To have a quick recap, we saw about how do we analyze balance sheet. We saw about how do we analyze a P&L statement or otherwise called the income statement. We also saw how do we analyze the statement of changes in equity. And at last, we also saw how do we analyze the statement of cash flow. So hope you have got a clear idea on what are the components that you must take care on analyzing the financial statements of the company. Thank you all. See you all in the next video.